Hey traders, Jason here from Leavitt Brothers. Welcome to another edition of my State of the Market series. Before I get started, first quick announcement. It is time for our annual Cyber Week special. Buy an annual membership or subscription and get 3 months free. It's a great deal. After you add on the 3 months, it comes out to be less than $40 a month. You're not going to find anything out there that's even remotely close to that special. So to take the special, simply, you can go to the homepage here, click the subscribe button, and then just join for a year. And then I will manually add on the extra 3 months after your credit card is run. As a quick side note, there's like a double special going on because for the first time in 8 years, I'm going to be raising my price next year. Okay, the way I operate here at Leavitt Brothers is whatever your deal is, however you join, you get grandfathered in at that price, no matter what happens going forward. I have subscribers here at Leavitt Brothers that have been here for 10, 15 years, and they're still paying what the subscription cost 15 years ago because they get grandfathered in as long as they remain a member. So it's kind of like a double special. Like if you join now, not only you get a good deal, but it's going to be the lowest deal it'll ever be because prices are going to go up. So if you've been thinking about joining, now's the time. If you were to subscribe in January, not only would this deal not be available, but then you end up paying a higher price also. All right, so if you've been on the fence thinking about it, now's the time. And all right, so let's get on with this video. So first I'm going to go through the indexes, and then I'm going to go through some breadth indicators. Market is not doing well right now. We've been pretty much all over it. I've been warning Leavitt Brothers subscribers for several weeks that the breadth was weakening. The internals just simply weren't supporting further upside, even though the S&P and Nasdaq were doing well overall. Honestly, this is going to sound harsh, but there's really no excuse because the warnings were right there in front of us. It was pretty easy to see the breadth was declining. So there's really no excuse for getting caught off guard with the weakness that played out at the end of last week and the weakness that's playing out right now as I speak. All right, so let's go through what I've been seeing and what I've been telling Leavitt Brothers subscribers over the last few weeks to make sure that they were fully informed and aware of the situation. All right, so first and foremost, here's the S&P 500 doing incredibly well, trending up, higher highs, higher lows, all that stuff, using the 21-day moving average as support. Nothing wrong here, no warnings. The S&P has been in really good shape. Nasdaq, same thing. It's gone up and over several times, moving from bottom left to top right. Overall, it has been in very good shape too. The problem has been with the Russell 2000. This is IWM, the ETF. It broke out several weeks ago at the end of October, and it is now in the midst of a 4-week losing streak. This has been the problem. As the S&P and Nasdaq have pushed to new highs, the Russell started to sell off and not support the move. Now, the Russell doesn't have to completely participate, but it can't fall behind too much. Okay, so if the S&P and Nasdaq are moving up and the Russell's like flat, that's okay. But if the Russell's falling, like 2% per week, like that's just not going to last. So this has been one of the problems that the market has had to face with. All right, so now let's look at some breadth. The breadth indicators I've been talking about at Leavitt Brothers that have told us that weakness was brewing. All right, so here's the S&P 500 versus the 10-day, 20-day, and 50-day moving average of the NYSE A-D line. Okay, just want to point some things out here. So first, as the market was moving up here, we had some good prints. Okay, 10-day near its high, 50-day or 20-day doing well, 50-day also doing well. The market continued up and printed a new high here, but as you can see, the 10-day moving average of the AD line was putting in a lower high. Okay, the 20-day was still in good shape. The 50-day was still in good shape, but on a shorter term basis, the 10-day was declining. Okay, so we're told that in the very near term, decliners were starting to outnumber advancers. Okay, then the S&P dropped, and then it moved to another new high over here. Okay, and as that was happening, the 10-day got even worse. Okay, so think about that. S&P 500 new all-time high, and yet advanced decline line wasn't just declining, it was way below zero and declining. The 50-day, not the 50, the 20-day MA was also declining and near zero. Here's the zero line right there, and the 50 had been declining. So as the market moved up, we had, let me erase those. We had a high here, a drop, and then another new high, and we had a divergence, 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 divergence. We were told on all time frames that this high here was absolutely not supported, that decliners were beating advancers. Next chart, this is the Nasdaq. Similar situation, or similar concept here, Nasdaq versus the 10-day, 20-day, and 50-day of the Nasdaq A-D volume line. Okay, so not the A-D line where all stocks get equal, say, this is the A-D volume line, so it measures the advancing volume versus declining volume. Same situation, it was happening, so I'm not going to go through this too much. We had a high, pullback, and then another high, and on that second high, we had a lot less advancing volume than declining volume. So we have a high here, but yet this is falling at a lower print. This was still in pretty good shape. Okay, so we were told in the very near term that even though the Nasdaq was hitting an all-time high right here, declining volume going into declining issues was greater than volume going into advancing issues. Okay, so beneath the surface, the gains were not supported. Okay, so this was definitely a warning. It definitely told us be careful, use tight stops, not a time to take big chances. All right, next up is stocks above moving averages. So you have the S&P 500 up top. You have S&P stocks above their 20-day moving average and S&P stocks above their 50-day moving average. Okay, so we have similar situation to the AD line. We have a high, and then a pullback, and then another high. And when this high was being made, we had less stocks trading above their 20-day moving average. And then when this high was made, we had less stocks again. Okay, number of stocks above their 50 were in pretty good shape. Okay, but on a short-term basis, we were told over here that this gain here was not fully supported. That over here we had like 80. Let me get rid of this. Over here we had like 84% of S&P stocks above the 20-day moving average, and that corresponds to like right here. And then over here, when the S&P was hitting an all-time high, we only had 70%. Okay, so a lot less stocks were participating, and it was a warning. Now, that doesn't mean the market has to crash. It doesn't mean it has to come down hard. It doesn't mean it's gonna top. It just means in the very near term, those gains were not supported, and we need to be a little bit more careful with our trading. Next up is the Nasdaq versus the Nasdaq 100 stocks above their 50-day moving average. Okay, the Nasdaq 100 stocks are your biggest, highest quality stocks within the Nasdaq. Your stocks like Apple and Google and Microsoft and such. So we also got a divergence here. So the market moved up here. That's a new high. We get a solid print here where like 75% of NDX stocks are trading above their 50-day moving average. Nasdaq moves down and then prints another new high over here, and this is, but this is right over here. Okay, by the time that happened, we're talking less stocks. Okay, so the market had moved down and then up. Okay, and I'm talking about up here. Market just kind of dropped off its high and then moved to a new high. But look at how many less stocks were trading above their 50-day moving average. Okay, so as the market moved up here, we had a lot less stocks participating in that. So over here, we had like 75% of stocks trading above their 50-day moving average. And then by the time the market made a new high over here, we had like 64% of stocks. So a lot less stocks came along for the ride on that new push. So that told us that push to a new high was not fully supported, and it didn't mean we have to go to cash, but it did mean be a little bit more careful, use tighter stops, don't take big chances. All right, now here's new highs. So up top we have the S&P 500, and the green here is the NYSE new highs. So quickly going through, we have the market making a new high here, but check this out, less and less stocks are hitting new highs at the NYSE. Okay, pretty simple. Like market makes a new high over here, And over here we have 230 stocks or so make a new high. Market hits a new high over here, but that time we only had 100 stocks at a new high. So at the same time where market's making a new high, we have less and less stocks, less and less individual stocks making a new high. And while this is taking place, we have new lows ramping up. So you got to ask yourself, when the market is hitting a new high here, we have less participation over here, and new lows are starting to ramp up. I mean, that's why would that happen? Internally there was some weakness. The S&P sometimes masks what's going on beneath the surface. New highs, new lows tell us what's going on beneath the surface. So we don't always get the full picture from the index. And then down below is the high low. It's just the highs minus lows, and you can see that it's been trending down for 3-4 weeks here, even though the market just hit a new high last week. All right, next up, similar concept. This is the Nasdaq versus Nasdaq new highs and new lows. Same divergence happened. Nasdaq prints a new high over here. Less Nasdaq stocks making a new high, and number of new lows are ramping up. Okay, so even as the Nasdaq is hitting a new high over here, you had less stocks making a new high, and you had a lot of stocks hitting new lows. Okay, and then the high low didn't just break down, but it was way below zero. So not only in the short term you can say okay, maybe we pull back hard for a couple of days, and short term new lows eclipse short term new highs. But this is 52-week new lows and new highs. Why would that many stocks hit a new low when the market is so right at its high? Okay, that's a warning. There's a lot of stocks not coming along for the ride. Okay, zooming in, we have here up top in the blue line is the S&P 500. Down below is the Russell 3000 1-month new high. Okay, so instead of asking 52-week new highs, this is just the 1-month new high. So same type of divergence happened. Market's at a new high here. Number of Russell stocks Russell 3000 stocks at a 1-month high low is at its highest level. So that's a lot of support. But the market moves down, moves sideways. It moves down and then back up, and then moves sideways for a couple weeks. And look at this. Little by little, day after day after day, less stocks are moving to a new 1-month high low. Okay, so this decline here tells you that 1-month decliners is stronger than 1-month advancers. So even as the market was up here at its high, and it actually hit a new all-time high right there, you had more stocks falling to a 1-month low than moving to a 1-month high. So there's a definite warning. So you should not, honestly, I don't like to get really confrontational, but there's really no excuse for being all in, ready to go when you have such an obvious warning. All right, so that's it. So S&P, Nasdaq doing well overall. Nasdaq or the Russell has definitely been a warning because it's been falling now for its 4th straight week. At Leavitt Brothers, I've been warning subscribers to be careful. I have been very honest and said I don't see a lot of good trades to be had. There have been a few good ones in the metaverse space, but otherwise there just hasn't been a whole lot of good trades to be had. And I've told my subscribers, lay low, don't trade aggressively, keep stops tight. This is not a time to really push it. All right, so that's part of the research I do. I offer trading ideas, which I consider to be the best trades at any given time. And if there are no good trades to be had, I'm just really honest, and I tell people I don't see anything out there. And then of course I do, I write reports daily and weekly where I show a lot of these indicators and talk about whether hey, light's green, let's go, let's make some money, or hey, light's yellow, maybe we need to tone things down, or hey, we got some major warnings here. Okay, so you got to ask yourself, would you have done better if you would have had these types of this type of analysis coming to you daily and weekly? All right, so I'll just finish up. Just a quick reminder, Leavitt Brothers Cyber Week special, buy an annual subscription, get 3 months free. Just simply go to the homepage, click subscribe, sign up for a year, and I will manually add on to 3 months after we run your card. All right, thanks for listening. Hope you're doing well. Good luck, and I'll see you next time.